Okay, on September 30th, TLC adjusted the prepaid insurance account to recognize 1 month's worth of insurance that has been used up. So this relates to the previous activity where they purchased an asset that has a long life. It's going to last 2 years, if you remember. So the TLC here is recording the activity of using up a portion of the asset that it previously purchased. Okay, the activity really is just the passage of time. But I think you can understand that as time passes, the prepaid insurance asset is getting used up. So let's look at our balance sheet equation. All right, since an asset is being used up, wealth is being used up or consumed, we're going to impact our retained earnings account. We're going to reduce it by 1/24th of the assets. So 2,400 divided by 24 months would be $100. So we're going to reduce our retained earnings by 100. All right, so likewise, that prepaid insurance asset that we set up is not worth as much. We've got to reduce its value. So we will also reduce the asset prepaid insurance. So our balance sheet equation is in balance. We need to ask ourselves, did the company consume anything or use up anything? And yes, since TLC consumed wealth or used up an asset, the income statement is affected, right? One of the definitions of expense is the using up of assets. All right, so this is an expense type transaction. The expenses will go up. Since expenses go up, that means that my net income is going to decrease. Net income and retained earnings are exactly the same, so we're good. This is the second transaction related to the purchase of the prepaid insurance. Again, I'm going to flip back to that diagram, and we're going to see that this is a deferral type transaction. What happened is that they paid cash up front, and later on, they recorded the incurring of the expense or the using up of the asset. So this is a classic type of deferral. All right. Next transaction. This is our last series. On April 1st, TLC received $6,000 from Thai grocers for mowing lawns. It's to be provided from April 1st to September 1st. Okay. So TLC is receiving cash that it hasn't earned. TLC has an obligation or a liability to perform the services in the future. This liability isn't, okay, liabilities are not limited to just amounts of cash that you have to pay to somebody. Liabilities can also be obligations to perform a service or provide goods. So this is a liability. So let's go to our balance sheet equation. All right, so TLC received some cash from a customer. So let's go ahead and look over there. It was $6,000. But we've already decided that they haven't earned it, so we're not going to impact retained earnings. So on the claims side, what has actually happened is that TLC has an external claim by a customer to perform services. The account we use for that is called Unearned Revenue, and it's exactly like it sounds. It's unearned revenue. It's a liability. We have to earn it. So we will also increase this account. So our assets and our liabilities, our claims, have both increased by $6,000. So this balance sheet equation transaction balances, and we're good. TLC has not earned any wealth or used up any wealth, so we can ignore the income statement on this transaction. All right, on May 1st, after mowing lawns for Thai grocers, per their agreement, TLC recognizes earned service revenue of $1,000, so that's 1/6. All right, so here TLC is actually performing the service and thus earning the revenue. The cash payment has already been received. Let's go to our balance sheet equation. Okay, so they participated in a wealth generating activity. So retained earnings is going to be impacted. As a matter of fact, it's going to be increased, right? Because it's wealth generating. So let's see, we said 1,000, 1/6 of it. Okay, but they didn't receive the cash in this transaction. They actually received the cash previously. But what they have done is perform part of the obligation. So they obviously don't have as much of an obligation, or the value of that obligation is not as high. So what I need to do here is decrease the related unearned revenue that we set up before. All right, so this is another claims exchange. We're reducing an external claim and increasing an internal claim. Since we have impacted our retained earnings, and we do know that they earned it, they performed the service, that means that we're going to go ahead and look at our income statement and increase our revenue. When revenues increase, that means our net income increases. And our net income and our retained earnings are exactly the same, so we're good. Okay, this is another deferral type transaction with cash being received first and revenue being earned later. Okay, congratulations for participating in this accrual transaction lesson. You can now go ahead and take the related exam. The next lesson will highlight transactions related to product-based sales and purchases.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.